Okay, you're going to have to forgive me now for the amount of math that's in this chapter. We're going to go through some depreciation and impairment and give you some of those multiple choice problems. There's a lot of math in this again, so just take your time with it, and hopefully we don't mix up those numbers, which can be very difficult. So I'm going to walk you through this depreciation problem because it walks you through these 5 different methods. So hopefully that'll give you a good example to follow. But what I would really recommend is taking and making yourself a little sheet that has all these formulas on it, so it's easy access to the formulas for all of this depreciation. So the first one we're going to walk through is straight line. This one's pretty straightforward. Remember, you take your cost minus your salvage value, and this is going to give you your depreciation base. And all you do is take that, divide it by your useful life. So let's go and find the information we need from this problem. Again, we're looking at straight line, cost minus salvage value, and we're looking for those number of years. So I take that 315 minus my salvage value, divide that by my useful life. Again, pretty straightforward. So let's go through and look at then the units of output. Units of output is going to be based on how many units you produce in total. So I'm looking for total units, and then for each year they have to give you this information, and I am looking at 2,500 total units. So again, for units of output, we're still using that depreciation base, but we're going to divide that by our total units. And that's going to give us our depreciation per unit. And then we take that and multiply it by how many units we've used. So in this example, we're going to take that depreciation base, which I've already figured out to be 300,000, divide that by my total units of 240,000, and that's going to give me $1.25. So for every unit I produce each year, I'm going to take that $1.25, multiply it by the number of units. So here this would be 31,875. Now working hours is done the same way, but it's based on hours. So we're going to look at the total number of hours and then how much they used just that year. So again, same formula here, so we're not going to have to memorize anything else on that one. But the working hours done again the same way. So we're still using this basic formula. And you're going to take that 300,000, divide that by the 25,000, and that's going to give us a depreciation per unit of $12, and then I'm going to multiply that by the number of hours, and I should get 31,800. Alright, now some fun ones. We're going to look at next, we're going to look at the sum of the year's digits. For the sum of the year's digits, all you really need to know from the information are the number of years. We're going to use that. And we're also going to use that same depreciation base. But it's done just a little bit differently. So sum of the year's digits. Your literally finding the sum of all the years you're going to use this. So I would go and say this is a 10-year salvage value. The first thing I want to do, unfortunately, is add all those numbers together. If you add all those up, you get 55. So that means each year, when you do the calculation, you're just taking whatever year it is, dividing by that sum of the years, which here is 55, and then you're going to multiply that by your depreciation base. Now here's a little bit different because we do have this year kind of split. They want the depreciation for the second year of the useful life of this asset. So in the second year, we're actually looking at a piece. So this was purchased in May. So in 2025, we depreciated 8 months, right? So what we're trying to do is calculate a full year for 2026. But when we're looking at the sum of the year's digits, we still need to, in year 2, we still have a piece of this full year left. So we're going to take that 10 divided by 55, multiply it by my depreciation base, and then I still need to use 4/12 of that first year of operation because I've only used 8 months in year 1. Year 1 looked like this: 10 divided by 55 times 300 times 8 over 12. So I need to complete that first year of the asset's life. So in year 2, I'm going to calculate those last 4 months, 18,182, and then from year 9 of the asset's life, 9 of 55, still multiply by that depreciation base, and then finally I have to capture the other 8 months. So you can see here in year 2, this is a full 12 months. I'm calculating the full 12 months worth, but it's allocated based on a full year of the useful life of that asset. So I'm going to add these up together. 50,909 I would depreciate. So again, year 1, and this is then what year 2 looks like. I have to split that up because these full years of the asset's life have to be accounted for. So that was your sum of the year's digits. And then finally, let's look at the double declining balance method. I shouldn't get lazy. All right, for the declining balance method, we also need some equations here. You have to find a depreciation rate where you take 100%. We're going to divide that by the useful life. And because this is double, we times that by 2. Here, our depreciation is 10, or our useful life is 10 years. So our depreciation rate is going to be 20%. The formula is book value times your depreciation rate. Because they want year 2, we got to figure out what we depreciated in year 1, because I need to find out that book value. So declining balance method, we do not use the depreciation base, we use the full cost. We're going to multiply that by our 20%, but remember in year 1, we've only held on to this for 8 months. So in year 1, I depreciated $42,000. That means in year 2, I'm going to take my book value, which is cost, minus my accumulated depreciation, and multiply that by 20%. I don't need to allocate it or by a percentage because it's for a full year. So this in year 2 would be $54,600. And that's what they were trying to calculate. So hopefully that helps walk you through an example of each of those methods. Now we'll take a look at impairment. Again, there's a lot of words here that I included everything just so I can explain a couple of things to you. But what we want to do is figure out, do I need to record a loss on impairment? And if so, how much and what does that look like? So when we're looking at trying to determine if we need to record the loss, we're going to look at this net cash flows. We're going to compare that to our book value or fair value. So let's show you what that looks like. We want to record the loss on impairment, and to do that, again, we have to find that book value. In this problem, my book value is $900,000, and I'm going to subtract my accumulated depreciation of $400,000, which gives me that book value of $500,000. Because my net cash is going to be less than my book value, I can record that loss on impairment. So I'm going to take this and subtract my fair value. So my loss is going to be $270,000. And to record that loss, I record loss on impairment. And that's going to be a debit for that $270,000. And the offset, the credit to that, goes to your accumulated depreciation. So it's that simple, pretty easy. They want to know where we would report this gain or loss on the income statement. It's going to go in those other expenses or losses section. It's highlighted as an unusual item. And then they ask, well, if the fair value then increased, do we do anything with that? The answer is no. We don't restore any impairment loss if the asset is in service. And then finally, what other accounting issues would be faced with this impairment? So I just wanted to kind of talk through a couple of these things so that we make sure we're aware of these things. Management, you have to first determine if there was an impairment. So we look at that recoverability test, and it estimates the future cash flow expected from that asset, and then its eventual disposition. If the sum of the expected future cash flows is less than the carrying value of the asset is impaired. So that's what we looked at when we said, okay, if the sum of the asset that we're going to get is less than the carrying value of the asset, which was this number, then it's impaired. And that's that recoverability test to see if we can record that loss. So those are the few things that I just wanted to make sure you realize that, or note the terminology there of the recoverability test, and that the impairment loss is the amount of which the carrying value exceeds the fair value. So there's 3 things we're looking at. This net cash flows If it's less than the carrying value, it's impaired. So cash flow, oh, there's too many W's there. That's less than the carrying value, the asset is impaired. Then we can look at and say, okay, we know it's impaired. By how much? That's when we compare the carrying value to the fair value to determine impairment amount. And that's what we did to show you just a little bit here. The impairment amount, we determined the carrying value and compared it to the fair value, whereas just determining that if it is impaired, we compared cash flow to the current value. So looking at that cash flow and the current value. All right, let's walk through some of these. Sometimes when there's a lot of numbers, it's easier to show with examples rather than talk through them. So this one, we're going to come back to depreciation. We're looking at double declining balance method. They want the second year, so we still have to calculate that first year. And again, just wanted to note that for the declining balance method, we do not take into consideration that depreciation base. We just use that cost. So we do have to calculate year one just for our own purposes. We should calculate the depreciation rate, which I'm kind of jumping ahead of the game here. So if I take that 100%, divide that by 8, and times it by 2, that gives me that depreciation rate, which I did not write down. I just did the math beforehand. Oh, I did. It's 25%. All right, so if I take that 375, multiply that by 25% in year one, that comes to 93,750. Then in the second year of life, in year two, I'm going to take that 375 minus the 93,750, times that by 25%, and I should get 70,313. So the answer should be C. You notice they give you that 93, so make sure you pay attention to what year they're looking for. And I just wanted to go over one more time. They're computing the sum of the year's digits in this one. And I think that one's a little bit more confusing, so I want to make sure we go through one more example of that. So here we do use that depreciation base. So let's find that out first. 475 minus my salvage value. So my depreciation base is 450. Then I'm going to figure out my fraction that I'm using. This is an 8-year life. So I'm going to go ahead and calculate that bottom portion. And I'm using my calculating abilities. I usually do this on Excel, but my computer is shutting down. So that's 36. So now that I have that 36, I can calculate how much depreciation it is for each year. So remember to double check dates. This was bought in September of 2025. They do want the depreciation for 2026, but now we have to kind of manipulate the numbers a little bit to account for that. Because remember, now in 2026, we're looking at having start with this. Is it 8 years? Oh yeah, 8 years. I'm losing my mind here. Too many numbers. So we're looking at 8 years, but we've already calculated 3 months the previous year. So that 8 over 36 is going to go first. But in year 2, we have 9 months left of that. And we're going to multiply that by our depreciation base, which was $450,000. We'll take that, because I'm running out of space. We'll look at the second piece of year 2, which is year 7 over 36. That's going to count for the other 3 months of that year. And we're going to multiply that by our depreciation base. And if I add those two numbers together, I should get C, the 96,875. That's a difficult one. There's a lot of numbers involved, especially with those split years. So just take your time with those. I know I get confused. All right, let's look at impairment. Impairment, again, we're comparing that carrying value with the cash flows, and then we're going to see if impairment is involved at all, and if it is involved, how much it is. So here in this problem, my cash flows are $400,000. My carrying value or book value is going to be that $800,000 minus the $80,000 salvage value, and we're going to divide that by 20 years and times it by 10.5, because that's how many years we're at so far, because I'm trying to get my accumulated depreciation. So that equals $378,000. If I take my $800,000 minus my $378,000, that's going to give me a carrying value or book value of $422,000. I'm going to compare that to my estimated cash flows. Since my cash flows are less, that's impaired. Now we figure out how much it's impaired by. And I take that $422,000, I subtract the $280,000 of my fair value, and that's going to equal $142,000. So again, I'm looking first if it's impaired, then finding that impairment value. One more let's look at, and this is just again looking at impairment. Again, here's my cash flows. I'm going to compare that to my carrying value or book value. It tells me what it is here, that $570,000. Now my cash flows are greater, so there is no impairment. So that answer would be 0. There's no loss recognized. I know I went through a lot. I know it was a lot of numbers. Again, always ask me if you have questions or you need any additional help.